You just spent $200 a day per person to walk through those gates. Your kids are already asking for a $25 churro. The hotel cost $400 a night. The parking was $35 before you even got inside. And somewhere in the back of your mind, maybe for the first time, you're wondering, where does all of this actually go? Here's what almost nobody walking through those gates has ever stopped to work out. The park you just entered cost more to build than the GDP of some small countries. A single themed land inside it can cost more than $1 billion before a single guest steps onto a single ride. And the company that built it, one of the most financially sophisticated entertainment businesses on earth, still only kept roughly 28 cents of operating profit for every dollar you spent there. By the end of this, you'll understand exactly what your $200 a day is actually paying for, why building a new theme park is one of the most capital-intensive businesses in modern entertainment, and why even the most visited resort on earth has to keep raising prices just to stand still. Before we get into the numbers, you need to understand what a theme park actually is, because most guests walk through the gates and see magic. What they're actually walking into is one of the most complex operating businesses ever built, combining real estate, hospitality, entertainment, technology, intellectual property licensing, food service, retail, and logistics, all running simultaneously, all dependent on a single factor the park cannot fully control: whether enough guests show up every single day. Let's talk about the number that gets all the attention first: the construction cost. When Universal opened Epic Universe in Orlando on May 22nd, 2025, it wasn't just another theme park opening. It was the first major new theme park to open in Central Florida in 26 years, and at an estimated cost of $7.7 billion. It is the most expensive single theme park ever built. 750 acres, 5 fully realized themed worlds, 6 years of construction, including a pandemic-era pause that nearly killed the project entirely. To put that number in perspective, the Star Wars Galaxy's Edge expansion at Disney World cost over $1 billion for a single themed land. Disney built 2 of them, one in Florida and one in California, for a combined cost exceeding $2 billion. Pandora, the Avatar-themed land at Animal Kingdom, cost over $500 million. These aren't parks. They're individually billion-dollar bets on the belief that if you build something immersive enough, guests will come, stay longer, spend more, and come back. But the construction cost is really just your ticket to the game. It's the down payment on a business with one of the most punishing fixed cost structures in entertainment. Here's where that structure actually comes from. Walt Disney World alone employs approximately 77,000 cast members, making it one of the largest single-site employers in the United States. Every single day, regardless of whether a hurricane is approaching, whether international tourism is up or down, whether the economy is expanding or contracting, those 77,000 people need to be scheduled, managed, and paid. Every ride needs to be inspected, maintained, and cleaned before the park opens. Every restaurant needs to be staffed and stocked. Every parade, every fireworks show, every character meet and greet needs to be produced and executed as if it's the opening night every single morning. And here's the fact that stops most first-time investors cold. The cost of a single new major attraction, the kind that generates the social media buzz and the dedicated fan communities that drive repeat visitation, routinely runs into the hundreds of millions of dollars before it opens to the public. Once it's built, it needs to be staffed, maintained, and operated indefinitely, adding permanent operating costs that don't go away when attendance softens. Then there's the part that catches almost every new buyer off guard: intellectual property. Modern theme parks don't primarily sell rides. They sell experiences built around characters and stories that guests already love. The Harry Potter lands, the Star Wars lands, the Marvel lands, the Nintendo worlds, these don't generate themselves. They require long-term licensing relationships with intellectual property holders, relationships that cost money to maintain, that limit creative flexibility, and that require the park to build and invest at a level of quality that justifies the IP owner's willingness to be associated with the experience. Here's where the revenue model actually makes sense. Add it up. Tickets, the most visible revenue line, now generate only a portion of what a guest spends on a typical visit. Food and beverage, merchandise, hotel stays, and increasingly the add-on access products like Disney's Lightning Lane and Universal's Express Pass all contribute to a per capita spending figure that has been climbing every year, even as attendance has remained roughly flat or slightly declined at some parks. Disney's domestic parks reported per capita spending up 5% in the most recent quarter, driven by growth in admissions, food and beverage, and merchandise. That number is the single most important metric in this business. A park that can charge more per guest without losing the guest entirely is running the most profitable version of this business model that exists. If you want proof of how this plays out in real time, look at what Disney's Experiences division reported for the second quarter of fiscal 2026. Revenue came in at $9.49 billion, up 7% from the same quarter the year before. Operating income was $2.615 billion. That produces an operating margin of approximately 27.6%, which is genuinely strong for a hospitality and entertainment business at this scale. But here's the detail that actually tells you everything about how this business works. Domestic park attendance was down 1% in the same quarter. Fewer people came through the gates than the year before, and yet revenue was up 7% and operating income was up. The math works because per capita spending rose 5%, meaning the guests who did show up spent more than they had the year before. Disney is deliberately managing attendance and per capita spending simultaneously, raising prices not despite declining attendance but partly because of it, accepting slightly fewer guests in exchange for significantly more revenue per guest. Which brings us to the real question sitting underneath all of this. If the most sophisticated entertainment company on earth is managing this business by raising prices to offset flattening attendance, where does that leave the business long term? And what happens when the price ceiling finally arrives? The guests who can afford the full Disney experience keep paying. The guests who are being gradually priced out stop coming. And when they stop coming, they stop building the childhood memories that eventually bring them back as adults with children of their own. Let's build the two honest scenarios, because this is where the real picture comes into focus. In the good year, international tourism is strong, the summer season runs long and clear. A major new land or attraction has just opened, generating enormous earned media and a multi-year wave of first-time visitors who have been waiting to see it. Per capita spending hits a new record. The hotel occupancy rate holds near capacity. Lightning Lane and food and beverage revenue both climb alongside admissions. The enormous fixed cost base is spread across peak visitation, and the operating margin delivers something genuinely exceptional. And then, in a single more difficult year, everything tightens. In the bad year, international visitation softens due to a geopolitical shift, an economic slowdown in a key overseas market, or simply a strong local currency that makes American theme parks suddenly more expensive for foreign visitors. The fixed costs, the 77,000 cast members, the ride maintenance schedules, the entertainment productions, none of that changes because international bookings are down. Revenue per guest holds up reasonably well because the domestic guests who are still coming are the loyal, higher spending core. But total revenue growth slows and operating income compresses as fixed costs eat a larger share of a slightly smaller revenue pool. That gap between a peak summer season with strong international visitation and a softer year where the cost base stays fixed while some of the revenue softens is the entire story of theme park ownership condensed into one operating cycle. And unlike almost every other asset on this channel, this business doesn't just have operating risk. It has reputational risk because the product being sold isn't really the rides. So here's the honest question. If the most recognized entertainment brand on earth has to raise prices every year, manage attendance carefully, and still only keep roughly 28 cents of every dollar as operating profit, what is anyone actually buying when they buy a theme park? The answer, once you strip away the fairy dust, is the same answer that shows up in every business we've covered when the operating numbers get complicated. It isn't really about the rides. It isn't even about the characters. It's about owning the one experience that billions of people are willing to pay almost any price to give their children, the feeling that for one day, the world outside the gates doesn't exist. People think they're buying an amusement park. The operators who actually understand this business know they're really buying a machine for manufacturing belief, and belief, as we've seen everywhere from diamond mines to movie studios, is the most valuable and most fragile asset any business can own.